Okay, just to share, yesterday, day before yesterday, we had a deal with the US, and then the market trend has changed. The day after, the market has gone up, and yesterday, of course, it had gone up by 2,000 points, and Nifty has gone up by about 700 points. Uh, then yesterday also, the market fell in the morning. All the IT stocks, they fell down by about 6 to 7% or 7 to 8%. Anybody knows the reason for that? This way I have to. Yes. The new AI tool. New AI tool that was developed by US. AI tool. Anybody else knows about what he's talking about? Just raise hand. Or you know, anybody else? Yeah. So there is a new, tools and Anthropic tools is a plot, which is better than ChatGPT. So when the market fell down, so I just asked ChatGPT what's the reason why the market is falling, particularly all the IT stocks. So it's just because of the new Anthropic tool, a company called Anthropic. So they come with a new tool, which has been launched few weeks back, and which is going to in fact all the IT companies, the traditional IT companies which are offering services for companies. So all this job will be done by the new AI tool, and it's much faster and it can be lot of difference. So I immediately downloaded that software called Claude. Okay, just do that, available free, and it is much better than ChatGPT. So then I asked a few questions. I found it was working well. So I'll be just exploring it bigger more. So that is much better and faster, and that can displace a lot of jobs. Army of engineers who are working with all these companies, IT companies, they won't be required as such. So they were the kind of a scare. How far it is true and how far it is going to, do that, it's time will tell. Okay. So that Claude is a better, this thing. It's available free. How many students have already downloaded? Anybody have used the Claude? जब आपको पता चला न्यूज़ है तो you should have done the same thing immediately, ना? So Claude, you can just go to the site and just register. It's available free, and of course there are chargeable version. So for about say $17 a month. For ChatGPT, I always subscribe, but I'll do for that also later on. But I thought I'll just have a feel about how it is, how the free version works. Okay. So today we are going to take this question. Okay, and this is an international finance question, and then after we do this and you understand how it is done, then I'll give you a similar question. Okay, and you need to solve it. And it is good because it will be there for exam. Of course, you may or may not choose it this as your presentation, a group presentation, because there are 4 things which you have to choose out. So this is one. Okay. So we are talking about a company which is, making some dengue, this thing, vaccine. So a foreign company has, tied up with this company, and they are going to do. So this question I have already, shared. So you can just read this question again if you want. So for convenience, what I have done is, but I'll just take you through the question again a little bit as we move. So what I have done on the side, I have just put all the numbers so that I can link it to the Excel sheet. Okay. The first thing was basically, it says that the dollar rate is 82 rupees at the moment. Okay. And then we need to project the dollar rate for the next 5 or 6 years. Forecast the dollar rate. Right. So normally, you go to a forward market and check, what is the rate of the dollar. So, there is a link which I had sent on WhatsApp. So you can just open, I think whether I opened this here in the class earlier. No. So I think this is a class where I couldn't show that because I was not able to locate the exact file. Because there are multiple files which I have actually made. And then when the file I opened, it was not available. So somebody was asking a question at the back. I couldn't even answer. So I'll answer that question today. Okay. So this is the site. I don't know whether because you people have done your derivatives. So this is a site which gives you basically the forward rates. Okay. And the spot rate. So as you open, the spot rate today is 90.4015. Okay. So all the quotes are given by 4 decimal up to 4 decimal places. If you find any foreign currency quote, it is available up to 4 decimal places. There is a body called FEDI. So they have prescribed a rule for all the Indian companies. They have to give, when they are going to the interbank market. So you get 4 decimal places quote. Is that okay? Fine. So if you are having, if you just work out your rate and it comes to 6 decibels, so you have to make it to 4 decimal places, and there is a rule of doing that. So we are not going to discuss that. And so this is 90.3931. Okay. Now this is the interbank rate. Okay. So there are two kinds of rates which are available: interbank rates and the merchant rates. Are you aware of that? Anybody who has read this in your semester, there are two kinds of rates: interbank rate and merchant rates. Only I think you have some knowledge about it. So, when interbank is a wholesale rate, okay. When the bank deals among themselves, they look at the interbank rate. Okay, fine. Now, if a customer goes to the bank and say, I need dollar, so the bank will say, okay, we'll provide you dollar. Just wait, we'll give you the quote. So they will go to the interbank site, where the banks are dealing, and they'll find a rate. They add a margin, or they will have their own margin there and give you the rate for buying dollar or for selling dollar. So you may have gone to taking a dollar for your imports, or you need dollars for going abroad. So or you have dollars and you're going to surrender it. Okay. So there are two kinds of rate: bid rate and ask rate. Whenever you go to the market, you'll find he'll give you two quotes. One bid, another ask. Bid is the buying rate of the dealer. Okay. If it becomes the buying rate of the dealer, it becomes your selling rate. That means if you are an exporter, or if your dollars with you and you have to surrender it, you look at the bid rate. But in case if you are an importer, or if you have to buy dollars for whatever reason, then you will look at the ask rate, because that is the dealer's sell rate and your buy rate. Okay. And the ask rate is always higher than the bid rate. Right? So if you want to sell, he will take your dollars at a cheaper rate, but if you want to buy, he will charge you little bit more. Okay. Fine. That's called the spread. Are you aware of this? No. Okay. So there is a bid and ask rate, and bid for exporter or importer.
Right, would be the person who wants to sell.
So exporter. And for importer, what would the rate? The ask or bid? Ask rate. So ask, if you are, you will just remember, if you want that, if you are an importer, look at the ask. If you are an exporter, look at that. No, whether you are an exporter or whether you are going to sell the dollar for whatever reasons, you look at the bid rate. Okay. Now, this is the rate which has been given. One rate is given. It's not, like bid and ask here. It is a mid rate. Okay. And it is an interbank rate. Okay. Fine. So, so when you just go down here, so you will find the spot rate is 90.394. And then you have, rates up to say, 2 years. Suppose you want to know what should be the rate after 1 year. Okay. So this is the rate: bid and ask. Bid and ask. Okay. So 92.66 and 92.72. Okay. So depending upon whether you are an importer, you will look at an importer, it will be 92.72. So that means you are going to pay more dollars. And if you are an exporter, you will get these many, rupees per dollar. Is that okay? Fine. Suppose you are going to receive a payment after you are an exporter, and you are going to receive your money after 1 year. So you enter into a forward contract, okay, with a bank. So you go to the bank, and bank will say that the rate is 92.66. It is an interbank rate. So for the banker, this is the rate. This is a wholesale rate. So while quoting, he will give you 92.50, for example. Some money he is going to keep it for himself. So he is going to give you much lesser than this rate. Okay. Normally it is 0.01%, which is his commission. Okay. So it is not going to be 92.50. It will be 92.60 or somewhere. Okay. So he's going to give you at 90. So he's going to, he's going to enter into a contract, a forward contract, to buy the dollar in the interbank market. Because the moment you enter to, you are an exporter. You are going to sell the dollars. Okay. Fine. So you enter into a sell order. He's going to buy this thing. Sorry, I'm just having a little bit confused. So, it's like this. You go to the bank, and suppose you are an importer. Okay, fine. So you need dollars. So the banker will look at this rate and say, what is the rate for you? The rate is 92.72, and he's going to give you 92.75. So he's going to add his commission here. Fine. In export, he is going to reduce. Okay, so both ways it will work in his favor. So he's going to tie up in the interbank market to buy the dollar because you are going to buy from the bank. Okay, he is going to buy for 1 year forward, so you also enter into a buy contract. Okay, and he's going to enter into a covered contract to buy it from the interbank market, so that he doesn't have any exposure on his head. Okay, so what is the rule here? What he'll do the moment you go to the bank, so what do you want to buy out? Okay, so he will look at the rate and say, okay, you want to buy this. So he says, okay, should I close the deal? So he will give you a rate slightly higher than the rate which is quoted here. So you are going to enter into a forward contract to buy dollars after 1 year at a certain rate. Okay. Now you have entered the contract. So he doesn't have the dollars. So he's basically short of dollars. So he's going to enter a buy contract on the same very day, on the same very time, normally, to buy a forward contract in the interbank market. So that's called the covered contract. So first is between the customer and the bank, and the second is between the bank and the interbank market to cover the contract. Okay, fine. So this happens daily, day in, day out. This keeps on happening for the banks, and banks keep covering their transactions so that they don't have any exposure. Whatever they're earning is their commission only. They are not mandated. So please listen. I'm going to ask questions. Okay, and if you're not able to reply, आपके number cut them. So जबरदस्त. Okay. So this is a very important, learning. So the banks, they have to. What is the bank earning? Is it the difference between the forward rate and this? What is that? It's a commission. Okay. Beyond that, they have to immediately enter into a contract, cover contract. If they don't enter, or if they don't enter, say within a reasonable time, they're exposed to the currency risk on their shoulders. Okay, so the bank doesn't take that. Now, what happened was just about a few months back, IDPI Bank, you might have the IDPI Bank shares crashed. Okay, and there was an audit, and it was revealed that there were a lot of transactions which are not covered by the bank, and they were running into huge losses, crores of losses. So you go to the IDPI, you just Google, IDPI shares crashed because of, the forex transactions were not covered. So the auditors, they pointed out and they found that their shares, they had not covered their transaction, and this suffered a huge loss in the market. And it was basically a mistake. Okay, a kind of a clerical mismatch kind of a mistake, and they were not able to do it. Otherwise, it's in the inbuilt in the system of the bank, they need to cover those contracts. Is that okay? Right. So now the rates are given. Okay, 92 or something, 92.72 and 92.66, and there's a mid rate, and 230 is the spread. Okay, between the spot rate and the. So let's do it. Okay, I'm going back to the Excel sheet here. I'm going to explain that. So fine. So now what I did was, this was the old one. Okay, so I'm just going to put a red yellow sign here. I think you have this. You have this with you, where you have the, at the bottom you have the numbers.
So we have old one.
Old one. Okay. So what I'll do is that, I'm going to share this, so because you can also learn by seeing. Let the WhatsApp open. Okay. So, 1 year forward rate. So what I'm doing is I'm putting that rate here. Okay. So this was, the each time when I go and check, I put the rate. Okay. So now I'm going to just put the rate again. Okay. So, the rate is basically. Again, I think the same WhatsApp is not responding.
So it might be a network issue.
Huh?
It might be a network issue.
Network issues, yeah. So, no issues, sir. Suppose I take this rate, okay? Like I'm an importer, okay? So I take 1 year rate, okay? And just put this rate here, okay? In my Excel sheet. So you can just put the rate yourself, okay? Rate 1 year forward rate. You can write along with me, okay? So this is the 1 year rate, and the spot rate is, what is the spot rate? If you just check, the spot rate is 90.39, okay? Let me just copy this also. Okay. And just do the same, this thing. Okay, fine. And find the difference. So what is the difference between the forward rate and the spot rate? So I get 2.33 is the rate. Okay. So that means the dollar is 2 rupees 33 paisa expensive. Okay. So now what I do is I just calculate the in terms of percentage. What is the premium? Okay. On the base rate. Okay. Which is 90. So I get a premium of how much? So dollar is trading at a premium of 2.57. So that means 1 year forward rate is trading at a premium of 2.78 percentage. Okay. And now I told you that the bankers when they give the quote for the next year, a forward quote which is there in the interbank market, it is normally the interest rate differential, around the interest rate differential, of course. Mainly it is come from there only. So now we look at what is the interest rate differential between the two countries. Okay. Now what I do is that I go to this site, okay, trading view, okay, and find out what is the interest rate prevailing in India. This is the 10-year bond rate, okay. Normally you should look at the 1 year bond rate, okay, because interest rate is 1 year forward. So not normally 10-year bond rate is used for the equity this thing. So I can just change it to 1 year bond rate. So you will have the rates here, okay, fine. So I think again the sites are, it is there. So what I'll do, I'll just instead of going to the one, I'll go to the 1 year rate, okay, fine. So the rate will be there. Fine. So I'll take this rate. This is 10 year again. This is 1 year. And then I'll put those rates for India as well as for US. Okay. This is the 1 year, bond rate is 5.76. So I'm just going to put this. Okay. So I'm going to put it here, that 1 year bond rate. Okay. And then, I'm going to just see what is the interest rate differential we are saying. Okay. In the market, 1 year interest rates, what are there. Okay. So it is 5.761. So it is giving you in percentage. So I'm just going to format the cells here and say number 5.6. Then I go to the US rate. Okay. Look at the US rate. Then the US rate is, this, I've given up this thing here. Just look at me. I'll just give you the share of the file and then you can just do it for yourself if you want. So I go to this site and I go to the next this thing and pick up the US rate. Just and then I go to the 1 year rate. Okay, 1 year USD. So what was the question? How we will calculating the premium from the premium is basically the difference between the two rates divided by the base rate. That is the spot rate. Okay. Spot was at 90 and say forward is at 92. So difference is 2 divided by 90. So that's your forward rate. Okay, fine. So then I'm trying to work out that the difference is 2 point something, 2.5 or something. Okay. Is the interest rates also telling the same story? Are the banks figuring out the interest rates? Okay. So the 1 year rate is 3.50. So I can just put 3.50. 3.50. Okay. So then I can calculate the difference between the two. So it comes to 2.26. Okay. So this is 2.26 and this is 2.57. Okay. Slight difference is there. So that means forward rate is little bit higher than the 1 year interest rate average because of they have inbuilt into what is happening currently because foreigners were selling, so they are believing that there will be some more outflow which will be happening on account of the foreigners. Okay, because they had pulled out a lot of money, so they are factoring in some kind of a that input while giving you the rate. Okay, it is not exactly, but the difference rate will be this. Have you got it now? So it is basically the interest rate difference between the two countries, okay, which we have just gone to the bond rate and calculated what was the difference between the two bond rates, US and India, and figured out it was 2.2 something, and the premium is also virtually almost at the same level. Okay, is that clear? Now, if I see if it's available here. So let's do this question. I'll share the Excel sheet and then you can just go to these, things. Okay. Now, what we did was we were trying to find out the exchange rate. Okay, fine. So if you look at the which was called AFM one. So there is a course called Advanced Financial Management in CA Final. So I made some slides. I'll just show you some relevant slides here, which are towards the currency. So this is also moving slower. Maybe it is consuming a lot of RAM, the WhatsApp. Okay. So if you look at these rates, the foreign currency rates, I'll share this slide also later. So this is up to 2021, from 1947 to 2021. So the rate was, 4 rupees 76 paisa per dollar in 1947. So, as on 2022, of course, I have updated this thing. So this is a little bit older, which goes up to 2021. So it has gone up from 4 rupees 76 paisa to 72.55. Okay. So if you want to calculate, what is the rate, at what rate the dollar is going annually. So it is going up at 4%. Okay. That is the interest rate differential between India and America historically, because our inflation rate was around 6% and their inflation was around 2%. Okay. Fine. So the difference was 4% in this era. And that is the reason that the dollar has been appreciating on an average, CAGR, smooth average. Okay. So it's been going up at the rate, now it's close to about 89.90. Okay. So if you just go to the Excel sheet, you'll be able to check that. So 1947. So if you put the rate 1947, okay, as 4.75,